love the channel and find it useful in becoming a happy retiree. Subscribe today. Chris joins us from Cumming. Chris, good morning. Welcome to Money Matters. What's going on? How can I help?
Hey, Wes. Good morning. How are you doing?
Good, good. How can I help?
Hey, so I've got a question for you. It's kind of a two-part question, but I agree with you about the role of the stimulus and the tax cuts being positive for investments. Don't disagree with you at all. The one thing that I am concerned about, though, is policy error from the Fed. And I think one of the ways that can express itself is with the yield curve, with the 2- and 10-year treasuries. And so I guess there are some people, some investors like me who maybe feel like the Fed kind of suppressed real price discovery over the last 5 or 6 years and were, concerned about investing in maybe the next 5 years. I'm 55, so I've been a little bit more defensive over the past 3 to 6 months and just trying to figure out what I can do as somebody who maybe is a little bit more concerned about that, and if that could kind of overwhelm any positive effects from the stimulus you've been talking about.
Let me put this in context, Chris, and it's an important question and topic that we probably need to really have it addressed, and we need to spend some time on it. So I'm actually really glad you brought it up. And let me put this in context for our listeners. What Chris is worried about, and I've seen tons of articles, let's say, that'll pop up on financial websites that'll say, this ominous sign means recession 100% of the time, and it's about to happen. And it's, again, these are kind of these scare articles, but to some extent they're true. And what they're talking about, and I'm going to explain this in just a second here, is called the yield curve inversion. Now, to Wall Street fund manager, that is right. That's vocabulary 101. If you're not on Wall Street, let me explain that to you. Typically, when the further out, let me try to explain this. The yield curve is if you were to look at a picture or a chart of what you get paid on government debt. Typically, it looks like this. Short-term government bonds, 3-month bonds, 1-year bonds, they pay you a little bit. Let's just say 1%. In longer-term bonds, let's call 10-year bonds, they typically pay more because you're locking your money up more. So let's call it 3%. And then for a 30-year government bond, and again, this is just for illustration purposes, because you're locking your money up technically, or you're making a 30-year commitment, you get even more interest. Now we're talking 4%. So the curve looks as though it's upward sloped. It goes from 1% to 2 to 3 to 4 the further you go out in time. And that is what that's the yield curve, and that's what it typically looks like. And it kind of makes sense, right? You buy a CD and it's a 1-year CD, you get less interest than if you buy a 5-year CD because you're locking your money up further. What happens that's the normal yield curve. Over time, and this has happened, let's call it, if I go back to, let's say 1977, it's happened, let's call it 5 times. It happened in 1980, 82, 90, happened in 01, and then it happened in the last Great Recession. We got what is called an inverted yield curve. It's effectively, the yield curve goes upside down or backwards, meaning that you end up getting more interest for short-term bonds than you do longer-term bonds. So the chart, instead of sloping upwards, it takes a dip. And that, every time it's done that, or inverted, meaning that, let's say, a 10-year bond pays more than a 30-year bond, which it shouldn't really do, we've gone into recession. And that's exactly what Chris is worried about here. Every time, and you're going to hear more and more about this because we're getting closer and closer to it, every time you see the Treasury yield curve invert, meaning that long-term bonds pay less than short-term bonds, which shouldn't happen, that's a pretty bad sign. And if you go back again to Chris's point, the last 5 times that's happened, every single time we have gone into recession. Now, it doesn't happen right away. It typically happens about 12 to 18 months later. And once it happens, The way I look at this, you've got about a year before the economy does really start to roll over or go into recession. Now, you've got to watch this really carefully. So typically the yield curve, we say, let's say the 10-year Treasury pays 3, and the yield curve, by the way, is taking the 10-year bond yield. Today it's 2.8. Let's round it up to 3, minus the 2-year bond, right? So let's say, and today that's about 2. So now the yield curve is getting, the spread between those two is getting less and less and less and less. And when it goes to 0 or negative, that's the inversion. So that gets a little scary. Normally you want to see, let's say the 10-year Treasury at 3, the 2-year Treasury at 1, you have a positive +2 if you subtract the 2. Well, what happens if the 10-year Treasury is at 2.5 and the 2-year Treasury is at 3? That's an inverted yield curve. Now you've got a negative number, a negative spread. Then you're going to see recession. So what happens here, and today that spread is about 0.5%. It's about 0.5 or 50 basis points, call it 0.5%. And when we get into that range, we're getting closer and closer and closer down to 0. We got to really watch for it. Now, we can be in this range for a long time, Chris, and we can linger here for a year. We could linger here for 2 years. We don't know. So I would keep a really close eye on this. I really would. But even if it does happen, you typically don't see an inversion or you typically don't see a recession for another 12 to 18 months. In fact, if you look at what happens when you invert, so you get this danger sign. Again, we're not there yet. We might be a year or 2 away from that, even if it does happen at all. You've got about the average rate of return for the market, so the S&P 500, once you hit the inversion all the way to the recession, on average, the market still goes up, on average by about 12%. Now, there's some times where it did go down, but on average, you actually see the market move higher even after the yield curve inversion. And my point in kind of going through this quick history with you is that you got to watch for it. It is an almost 100% sign that if it happens, we have almost 100% of the time gone into recession, but we might be a long way from there, meaning that we're still a 0.5 percentage point away on that spread to get there. And we could go a year or 2 years before we even get there. And then once we get there, typically you don't go into recession for another year and a half. So we might be 2 to 3 years away, Chris. And I will keep you up to date here. So we will, now that we've talked about this, and I should have talked about this before, but now that we've brought up this very scary sign, we're not there yet. We're actually pretty far away from that happening, but it's on my radar. It's on your radar, and we're going to keep it as a really important topic here on Money Matters, yield curve inversion, because it basically gives us the forecast, hey, we're going into recession. That's the bad news. The good news is we're not there yet, and we're actually pretty far away from that for now. Chris, thank you for your question. It's super helpful, I think, to our audience to understand that you got to watch interest rates. So we've got to watch that, and we will continue to do so. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.